If you're in a position in the United States to buy a house outright with cash, good for you. You've worked hard to do that, and that's a fabulous position to be in. Most of us are not there. Whether you're a first-time home buyer, whether even if you've owned a few houses and you've sold one to pull out some of that equity to put money down on a new house, a lot of people cannot afford to pay 100% cash for a house, so we need to use the vehicle or the tool of mortgage loans in order to bridge the gap between the cash you have and the amount you're putting down on a house, or the amount you're purchasing the house for. So today we're chatting with Jay Garvins. He owns Churchill Mortgage in Colorado Springs. He's a fabulous guy. He serves people well with integrity like I do, and he'll help us understand the 8 things that you should ask yourself and paradigms and programs that you should know a little bit more about as we talk about the terminology of lending and mortgages as a tool to purchase property. So let's check it out. I connect with people just like you every day to help them discover where to live and invest in real estate and sell property for top dollar when the time is just right. My name is Leif Jacobson. I'm an ex-cop turned realtor, also known as Safe Leif. If you're new to this channel, subscribe so you're first to learn about Colorado real estate, all things Colorado real estate. Love to be a resource for you. And also my contact information is below, and I would love to connect with you. Please reach out by text, call, or email after this video. I'd love to hear from you, or book a calendar item or a calendar event, and I will reach out to you, whatever works best for you. So let's get into it with Jay. Here's the interview when I pulled Jay aside and said, hey, let's talk about the 8 keys that people should understand as a buyer or a utilizer of mortgage tools. So here we are with Jay Garvins, owner of Churchill Mortgage. Jay's a buddy of mine. We've been working together for years.
Yeah.
I trust Jay implicitly. And what I love about Jay is there's no smoke and mirrors. It's all up front. Everything is full disclosure. Sometimes numbers and there's, things that aren't so clear, or there's kind of, some lenders play games up front, to be honest. I don't know that it's malicious all the time, but sometimes it feels like things aren't up front and kind of apples to apples as far as the numbers and stats. And when I'm referring a client to a mortgage broker or a lender, it's a huge deal as far as that reflects on me and my reputation as well. So we're all working together as a team.
Yeah.
We're all serving clients as a team. We see it as a team play, and that's what I love working with Jay.
Good. I appreciate you having me on, my friend. We'll kind of go through some mortgage questions I get every day, whether it's with a client at my desk, over the phone, FaceTime, in a classroom, or even on a podcast or radio show that I do.
Yeah, and what we're going to cover are the top 8 questions that you should be really asking yourself when you're going to get a mortgage loan to see about purchasing a property with the vehicle of a mortgage loan. So there's really key information to know and learn, and good questions to be asking yourself so you're well informed coming into that process and going in eyes wide open.
Yep, and you said the most important question people ask, how much mortgage can I afford? Which really means how much house can I afford, and how much money do I have to put down, and how much mortgage do I have to get qualified for? And the question is, legitimate. I think people make it too complex. It comes down to your debt ratios from the bank's perspective, from the mortgage lender or the broker perspective. Being with Churchill Mortgage and embracing debt-free home ownership, I think it has more to do with your personal family budget. The problem with that, Leif, is 90% of the people I sit down with don't have a budget.
Yeah, that's right.
The biggest mistake is individuals say, how much can I afford in a monthly payment? Because we live in that world. You've got your utility payment, you've got your cell phone payment, you've got your car payment. And so what I say is, if you have a budget, your house payment really should not be more than 25% of your income. Now, you can decide whether that's going to be your gross income.
I was just going to ask.
or your net income.
Yeah.
I'm going to say it's your net take-home income, but again, you're talking to a Churchill Mortgage, debt-free ownership, Ramsey Solutions tribal member. And so it's basically 25% of your income. I say your take-home income. Or you want to make sure that you're not buying a house that's more than 4 times your annual take-home income. That's for you alone, if that's where you're at, or it's with you and your significant other, or in the case of a veteran loan, it has to be a spouse.
Yes.
So that's the basic question. But then debt to income, DTI, comes into place. How much debt do you have? How much income do you have? And what's the percent in there? It fluctuates. The general rule from a bank perspective is you have to be between 26% to 36% of your overall gross income can be assigned to your housing expense. And then the top end ratio, which means your house payment or your living payment, added in all of your unsecured credit reported debt. Doesn't include your cell phone unless it's reported on the credit report, which they're not. It doesn't include your utilities. It just includes installment loans, line of equities, and separate loans that are listed on your credit report. So 28 to 36% of your take home or your gross income on your housing payment, and no more than 42 to 49% overall ratios. Call it, hey, if I got all these bills plus my housing payment that add up to 50% or more of my gross income, that's a red flag.
Got it.
Okay.
I love that you're talking about pre-approval versus budget, because most people are approved for way more than they would want to spend.
Absolutely.
Or they want to make a payment on.
Yep.
So those are two different things. It's like, great, if I'm I can take out a loan for $780,000, but I don't want to make that payment.
Yeah.
And that's a huge difference right there.
And then your next question, of course, is, okay, what do I need to get qualified? And I like to dumb it down because I'm a pretty simple guy. There's 3 C's. You can search the internet. Some people say there's 4 C's, where you include your character, which is like, I mean, what does that mean? It's credit, your capacity to earn, and your collateral or down payment. So your credit is actually your unsecured and your secured debts. A home is a secured debt. A line of equity is a secured debt. A car loan is unsecured. A appliance or a sofa loan is an unsecured. If you're like, you have a fancy parakeet, that's unsecured. I don't care, he can fly away. So the first credit explains what your accounts are, but really it comes down to a Fair Isaac Company score. So that's a FICO score. And your FICO score really needs to be above 620 points or higher, which is barely going to get you in the door at like a C- rating. If you start to get above a 680, you might be to like a B. If you're 720 and above, you're an A. If you're 780 and above, it's just bragging rights, like at a cocktail party saying I got an A+ rather than an A. Again, what does it matter? Someone bragging about getting an A or an A+. Credit is credit. Now, you can get some approvals as low as a 580, 520 FICO score, but it's going to be trying to dig into granite. It's very, very difficult. And then the second one is your actual capacity to earn. That's your paycheck. Hey, your W-2 income, if you go ahead and make $5,000 of gross income a month, that is $60,000. And if you have $20,000 a year of actual debt, then you're going to have like a 30% debt ratio, but your capacity to earn your wage has to be at least established for 2 or more years. It can be at a W-2 level, it can be at a tax return level, but that determines your capacity to earn. And then, of course, the one that hits people the most is your collateral. Yes. I have a lot of people with good income and good credit scores, but because they live month to month and everything's how much can I spend every month and they max that out, they have no savings plan, they have no money to put down.
Right.
So you look at your credit, your capacity to earn, and your collateral down. And then, of course, you have loan programs like a veterans program allows you to put 0% down. Easy to get. Just go serve your country for 2 years or more. Get the GI Bill and a VA loan. Easily done. I've done that for 15 years. when I served in the military. Then you got an FHA loan and a home ready loan in a conventional fashion that can get you 3 to 3.5% down. But the traditional way that we teach is that if you're going to purchase, you want 5, 10, or 20% down. I say 20% down, but it's more important to get into the real estate market and get into the game,
Yes.
I believe, than to fester at your down payment. Now, am I going to tell people to go buy a house when they got a truck payment, a camper payment, and a dog or cat payment? No, you're really setting yourself up for failure. But different lenders do it in different ways. Some people will take you through a contract or an application. I take individuals through a lifestyle decision of how they're going to succeed in life, and that's understanding the elimination of unsecured debt, the acquiring of secured and accumulating wealth like a house, a business, such like that.
Yes.
But bottom line with that one is it is your credit, your capacity to earn, and your collateral.
Because if you wait until all the little fine-tuned things and all the numbers are just perfect and you never buy, then you don't have hundreds of thousands in equity that you might have had you bought earlier or later.
Absolutely. And please understand, the biggest thing that we're talking about is that rental is an expense and a housing payment is an investment.
Yes.
It's in an appreciating asset. All of the money you pay, you're going to pay rent the rest of your life. You're going to make a housing payment the rest of your life. It's just whether you're going to make your landlord some accumulated wealth and appreciation, whether you're going to make yourself accumulated wealth, money or appreciation. And then in the end, even when you own the house outright, like my wife and I own all of our rental properties outright, we still have to pay monthly rent to our insurance company and the tax god, the property tax, the rest of our life, but it's much smaller.
That's right.
And then, the next question, Leif, is always, well, those are the terms that I need to get qualified under with credit, capacity to earn, and collateral. What type of loan am I going to get? And am I going to get a fixed rate or am I going to get a variable rate? Am I? And there's 3 types of loan programs out there,
Okay.
which there is the conventional loan, which is by GSE, government-sponsored entities, Fannie Mae, Freddie Mac.
Yes.
That's the most popular. More than 75% of all people getting qualified do that. Then you have govies. You have government loans, which are government-sponsored agencies, and that's the Veterans Administration, VA, and FHA. VA, you have to have been a service member. There's qualifications there. If you're a service member, you can get with Leif or you can get with me. FHA is really a program that does its best to encourage and help first-time home buyers. And then the third is your non-conforming products. You have individuals that are older that want to do a reverse mortgage. That's a non-conforming product. You have individuals that want to do a house that isn't complete. You're buying it and the bathrooms aren't complete and
Right.
the kitchen cabinets
Renovation
aren't in.
loan.
Renovation loans, but we're
Oh, that's
purchasing.
something different.
And no, renovation loan would be a non-conventional product, but your purchase loans and your commercial local banks, those are all non-conventional. And then it
also
comes
called portfolio loans.
Yep.
Yeah.
And then you can go ahead and do those in a fixed rate. Conventional does fixed rate or variable. VA does fixed rate or variable. 95% of your portfolio or non-conventional loans are going to be variable and you don't have an opportunity. Right now, when do you want a variable loan as opposed to a fixed loan? Right now, your variable loans cost more on the street to acquire than fixed loan. So you'd have to be a little bit of a boob to go with a variable loan right now because it provides you less security and equal or more expense. So,
And a quick explanation on the variable versus fixed rate. Some people don't know those terms. What's
Yep.
the quick
A
bottom line on
variable loan is that you only have a rate that is promised for 1, 3, 5, or 7 years. After that, it varies with the market. For example, line of equities are variable loans. A second mortgage is a fixed mortgage in a second position behind your first, and a variable loan can either change on a monthly basis, like a line of equity, every month, just like your credit card. It changes depending on what the Treasury or the LIBOR, the London index, is doing, or the US 10-year Treasury is doing, or the prime interest rate is doing. But then you can have a first mortgage, and that's always going to be on a 6-month, a 1-year, 3-year, 5-year, or 7-year fixed period. And then you go into a formula of adjustment after that. And a fixed is fixed for the term of the loan, whether it's a 15-year term, a 20-year term, 30-year term, or anything in between.
And generally, it's a risk assessment for them. So the less amount of time they're fixing it, the better rate they can offer, because they don't have to guarantee that 30 years from now in a certain rate.
Yep. But right now, because everybody knows that as soon as interest rate, when I say everybody knows, in the secondary servicing market, the people with the names on the mortgage statements you get every month, that as soon as rates go down, you're going to refinance. That's why right now, loan discount points, or the requirement of an expense with acquiring that interest rate, is very high.
Yeah, for an upfront fee, you can buy down a lower rate.
Yeah, you know what we called that 10 years ago? Loan origination. Now we still don't have loan origination, we just have mandatory discount rates.
And the way I think about that is that
same thing.
You're basically prepaying interest, is what you're doing in a fee up front like that. It's kind of how I think of it. Is that right?
Well, that gets into APR, your annual percentage rate. That money is a cost of acquiring the loan. And right now, if they know that as soon as interest rates go down, people are going to refinance, and that's going to be before 3 or 5 years, which it takes a servicer that long to recapture the expense of buying that product and then providing services. Every point that you pay basically is a year of profitability that they believe, the investors on the secondary market, that they need to sell that product. So that's why you can't get a loan right now, period, that doesn't have at least a 1% upfront fee, and as much as 5 percentage points for an upfront fee. Call it loan discount, call it loan origination, call it peanut butter and jelly. It doesn't matter what you call it. It's 1 to 5% upfront fee for acquiring that, because the industry knows through the habits of Americans that they're going to refinance and get rid of that product as soon as it lowers. And I don't think anything's going to lower dramatically between now and the first quarter of 2025. So they're going to want some stability in that product after the first quarter of 2025.
Yes.
And then the next thing everybody always asks, Leif, as well, how much money do I have to put down? And that just depends on whether you want to have private mortgage insurance or not.
Yes.
And what private mortgage insurance is, it is an insurance that protects the investor from that loan going into foreclosure. Period.
I was just going to say, is there any benefit to the borrower or not so much? It's really to hedge the risk for the lender.
You think? The benefit to the borrower is they get money. So if you put 20% down on a house, there's no risk statistically. So you don't have to pay PMI. But if you want to put down 0%, which it seems everybody wants, or 5% or 15%, you're going to have to pay a fee on a monthly basis because you picked a project that has a higher proponency to land in foreclosure.
Right.
Period. So until you get at least 20 or specifically 22% equity, there's going to be a requirement federally on all conventional and on government products to have some type of mortgage insurance premium or private mortgage insurance. Private mortgage insurance is the definition for conventional loans, and mortgage insurance premium, MIP, is for FHA, and VA just does an upfront funding fee with no monthly requirement. But all of it is to squelch the risk of that product going into foreclosure.
Yes.
They demand it of the investors, and the investors are like, okay, that's the cost of doing business. I'm going to pass it on to the end user. That it happens with everything. I mean, when you increase taxes on business, they're like, that's fine. We're just going to pass that on to the
Yes,
user.
that's right.
I won't get into the politics of it, but after that you say, hey, how much money should I put down? Well, I'm over 50. My wife and I have budgeted and planned and helped thousands of people. I've helped over 4,000 people do this through their career, through my career of buying a house.
Yes.
And if you're a first-time home buyer, put down as much as you need to get into the housing market. Because once you've hopped on that train in the train station, you're forever on the train with momentum.
Yes.
If you're sitting in the train station and trying to get on the train of home ownership, right now that train is moving very slow, Leif, because interest rates are high, sellers can't sell, buyers are fearful,
Yes.
and Warren Buffett says, when individuals are fearful, be bold.
Yes.
He says something different.
Yeah.
When others are bold, be fearful.
Yes.
And right now the train is moving slow, so you want to hop on.
That's right.
Because you can get a house for $50,000 less than you could in almost any market, especially in Colorado Springs. If you go into zip codes and neighborhoods that are attractive for purchasing right now, you can get a house for $50,000 less than you could in just the beginning of 2022.
Yes, that's right.
So if you have to pay if you have to pay $500 or more right now for a mortgage on a house, but you're getting it for $50,000 less, if you divide $50,000 by $500, that's $100, which means you're ahead for 100 months. Hop on the train.
Basically, you want to be buying when no one else is buying, and you want to sell when no one else is selling. You do opposite of what the market is doing, which is totally counterintuitive.
Yeah, it is. Because in 2021, it wasn't the time to buy, because not only did you have to qualify for the loan, you had to have some cash to offer $15,000 to $45,000 over asking price, appraisal gaps, all of that.
Yes.
So I'm going to say, if you're a first-time home buyer and you have wealthy grandparents, get a gift and put 20% down. If you don't, put 5 or 10% down, or whatever you need to get into the market. After that, if you're purchasing your second home, you should at least be putting 20% down, but you're rolling the equity from your previous home, or your income is more. If you start to get into your retirement years where you're 50 or older and you're not putting at least 30 to 50% down on the house, you just don't have the correct advisors.
Right.
And of course, through Ramsey's Solutions and Dave Ramsey's Baby Steps, you want to put 20% down or more, and then he'll go one step further and I'll go one step further. If you have the salary or the wage, you take it a step further of not only putting 20% down and having no unsecured debt, but you want to seriously consider a 15-year loan term rather than a 30-year loan term. I didn't do a 15-year term on my first home. I just got into the market. But out of 10 loans I've had in my life, Leif, 7 of them have been 15-year mortgages. And it's no wonder that I'm 50 years old and I have 6 out of 8 of my homes with no mortgages, because you would think a 15-year mortgage is half of the length of a 30-year mortgage. So common sense would tell you the monthly payment would be double.
Right.
It's not.
Right.
It's only about 60% more.
Or you pay half of the interest, but it's
Yeah.
actually way more than that.
Wait, because of compounding interest. So if you're asking whether someone should do a 15 or 30-year mortgage, I would literally say consult with your mortgage professional. Notice I didn't say application taker. If you go to a credit union, or if you go to a big box like a Chase or a Wells Fargo, they're just going to take an application. You need to find a standalone mortgage company like Churchill Mortgage, First Choice, someone that is a full lender, which means that you can do an application, they fund it and then also service it. But you want to make sure that you get advice and not just someone walking you through an application.
Will you speak real quick to just making extra payments versus, say, if you have a 30-year mortgage and you just want to make extra payments toward the principal rather than going to a refinancing to a 15-year loan? What's the difference, and do you have a recommendation there?
Sure. The loan that you have does not determine the number of years you're going to have the loan. It's how many payments you apply. So if you have 12 payments on a 30-year mortgage that are $1,500 a month, if you just stay on the exact same payment schedule and pay a 13th payment a year, one extra payment a year, that's not going to be a 30-year mortgage. It's going to be a 22-year mortgage. So literally, if you go ahead and make 2 or specifically about 2.5 extra principal payments a year, then you're going to have a 15-year mortgage, regardless of what the term is. And in this environment right now, where people have 3% and 4% mortgages, rather than refinance, you can just pay extra principal towards it, and it's going to make that pile of money that you owe shrink faster.
Got it. Let's talk about closing costs. And bulk of closing costs for buyers come in the form of obtaining the loan, which is understandable. Is there a way to finance those? Would you even recommend putting those into the loan or financing those? Or you always recommend with coming in cash that way?
It's impossible. You can't finance your closing costs.
Okay.
Now, the seller can choose to give you seller proceeds. And if the seller gives you seller proceeds, then your proceeds from the seller can be applied towards your closing costs. It's kind of a cat chasing its tail, because right now it's available, because houses 6 months ago were selling equal or higher prices than they are now. So you can have a seller that says, hey, instead of selling you the house for $500,000, I'm going to sell the house for you for $510,000, because the appraisal will justify that, even though the demand in the market won't. So they'll give you $10,000 of seller proceeds. You're now paying retail for the house as opposed to a discount with the high interest rate environment we're in. You can use that. In essence, there is a portion of that will technically be financed over the term of the loan. But that's a gift or a negotiating tool between like a buyer agent like you. That's why choosing a buyer agent matters. Some, like you, Leif, might be able to negotiate that into the contract. Others won't.
Yeah, we do that all the time.
Yep. And right now, it's one more reason why it's advantageous time to purchase, because in 2021, people would laugh at you. No, you're not going to get any seller proceeds. In fact, the guy next to you wants to give me $20,000 above the value of the home. Get in line.
Right.
But there's going to be closing costs, period. And I think this is just hilarious. People are like, can I negotiate down your seller fee from 6% to 4%? Can I negotiate down your loan costs from $7,000 to $3,000? Sure, you can try, but for me, think of it. If you were to go into a doctor that's healing your son's arm or your girlfriend's leg or your boyfriend's head, and say, hey, the other doctor said he could do this surgery for $15,000 and you're saying $20,000, you're gonna dumb yourself down to the worst qualified surgeon, period. It's the same way as saying, hey, would you go to a part-time dentist?
Yes.
He's pulling a tooth.
That's right.
Probably not, but people go to part-time lenders and part-time real estates that do 1 or 2 transactions a month or 1 or 2 transactions a year. But they would never do that with a tooth or a broken arm. And the point of the matter is that when you're dealing with mortgage professionals, you're going to pay closing costs no matter what. Somebody is going to pay a closing cost. You can try to make someone else do it. Right now, because of inflation, it literally is $5,000 to $7,000 just for closing costs that won't be returned to you. if you pay homeowners insurance at closing, which is called a prepaid item, it's a fee at closing that benefits you in the insurance and protection of the house over the next 12 months. You may pay an individual real estate agent, an appraiser, or a mortgage lender. You're never going to get that fee back. That's what's determined a closing cost. So in a closing cost scenario, you're going to have $5,000 to $7,000 of closing cost fees. The seller can offset that. Your lender can offset that. Your parents can offset that, but someone's going to pay that fee, because just like an individual who is an IT employee at Meta, it doesn't matter whether you call it a commission, a wage, or a salary, people need to be paid.
Yes.
Good?
Okay.
What else do we have?
I think that's about it today. Thanks for joining us. Thanks for taking the time to engage with us. Jay and I are both wholehearted men. We're real, we're authentic, we're very straightforward, we're very good at what we do in business, but we're also very relational. We're all about connecting and being a genuine resource to people. That's what it is. There's no pressure at any time. It's all about being a resource and asking the right questions. Because if you don't know what you don't know, my wife and I say all the time, and asking the right questions like today and knowing what you're talking about, even listening to this and going in and talking with a mortgage broker, whether it's Jay or anybody else, you go in way more well-informed, so you can make the right decisions for yourself. It's not about us telling you what is right for you. It's about you being educated and you being supported and us being an advocate for you, so you can make the best decisions for you and or your family. So thanks for joining me today, Jay.
Absolutely.
Thanks for being a resource to me. Appreciate you.
Okay.